Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, September 6th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, futures, we do show green. We got the Dow Jones futures up about 170 points, S&P 500 futures up about 18, NASDAQ futures up 44. We were up a little bit more than that, probably an hour or so ago. So we have pulled back a little bit, but it does look like, at least for now, that we are going to get off to a pretty good start today. Still got another hour and a half or so before the market opens. So we'll see whether or not these gains hold. For today, let's go through the agenda. I've got the daily market recap, talking technically relative strength, sentiment, earnings spotlight, and the 3 you must see. Before we get into any of that, though, let me take you over to Earnings Beats, where if you scroll down, go to earningsbeats.com, scroll down, and you will find an area where you can sign up for our free newsletter. This is a 3 times a week newsletter that comes out Mondays, Wednesdays, Fridays in the morning, usually about an hour before the market opens. Tend to focus on the things that are really important to us at Earnings Beats, so things like earnings, gaps, relative strength. I'm going to talk about relative strength today. Those are the things that we tend to feature. Specifically, we could get into candlesticks, maybe price volume, key support, that type of thing. But it is a potential trading opportunity if you like to trade individual stocks. Occasionally, the EBD will focus on sectors, industry groups, but for the most part, it is taking a look at individual stocks. So make sure you go to earningsbeats.com, scroll down, and sign up for our free Earnings Beats Digest newsletter. There's no credit card required. You can unsubscribe at any time. All right, let's move on to the daily market recap. So Friday was an interesting day. We had a really nice gap up at the beginning of the day, but by the time the day was over, we had gone quite a bit red. This was after a nice reversal on Thursday. So with the gap up on Friday, it looked like, okay, here we go back to the upside. Market was having none of it. We pulled back. Dow Jones Industrial Average finished down over 1%, 338 points. S&P 500 also down over 1%, 42.5 points. The NASDAQ dropped 1.31%, 154 points. Mid caps down 0.75%, small caps down about 2/3%, and all of the major indices, as you can see now, trading beneath both the 20 and the 50-day moving average. So the configuration here clearly in the short term is more bearish. AD lines, I think, still remain pretty good, considering the drop that we've had since mid-August, this huge drop. Really, the AD lines have not come down that much off of their recent highs. So I think at least the theory of Wall Street continuing to accumulate while others sell in the morning, for the most part, continues to hold true. Moving on to the sectors, energy was the only sector leading, or was the only sector up on Friday. It was obviously the leader, up nearly 2%. So XLE bouncing off that 20-day, got back up above it. We'll see if it holds. Communication services, that was the number one laggard on Friday, dropping almost 2%, down 1.9%. You can see clearly this is a very weak group, almost down, back down to that mid-June low. The other sectors quite a bit off those lows still. Real estate down 1.7%, healthcare 1.44%, and then staples down 1.3%. These last three all defensive groups. That was kind of interesting, and I think as we look at some of the rotation on some of the charts I show you, rotation is still holding up okay. It's not great, but it's certainly not bearish based on how my sustainability ratios are looking versus the S&P. Again, we'll take a look at that in just a couple of minutes. 10-year Treasury yield. Let's take a look there. Currently, we have the yield back up this morning. It's up 6 basis points to 3.25%. So hovering right in this 325 area. I don't personally, this is one of the things I'm worried about. There's not a whole lot that I'm overly concerned about right now. I mean, obviously the major indices are down below some key moving averages. That's always a concern. But when I look at some of the areas to try to figure out, under the surface signals, The 10-year Treasury yield is one that I'm at least watching. I think rates can go up. I wrote an article over the weekend. I think rates can go up and the market can still go up. We did it through 17 rate hikes in 2004. We did it throughout the 1960s. And I think the key is that rates are starting to go up from a very low level. Now, if you're talking about raising rates and you're already at 4 or 5%, that's when I think you could run into some really big troubles in terms of the market moving down substantially. I just don't see that. I don't see the rates going up like that. I think even these last few months, even though the Fed's been talking tough about inflation, they've been raising rates, talking about raising more. 10-year Treasury yield really not pricing in a whole lot. And while the 10-year Treasury yield doesn't react to the short-term rates at the, when the Fed hikes and lowers, the 10-year Treasury yield does react to inflationary pressures. You're not going to be interested in buying a 10-year Treasury yield unless you've got inflation expectations built in. And I just don't know at 3.19% if that's got a lot of inflation expectation built in, not long-term. I mean, again, we're looking at a 10-year note. Who wants to buy this thing and hold it for 10 years if you're worried about inflation? So I think the 10-year Treasury yield is low enough where it certainly, in my view, reflects Wall Street's non-concern for these inflationary pressures. At least they're not concerned about it lasting. And so we'll see how everything plays out. But that 10-year Treasury yield did not go above 3.25% for 11 years until mid-June when we broke out. And that's when we set the low on the S&P 500. So if we were to move back up and take out 348, the first 325, because right now this just looks like a false breakout above 325. If we can get through 325, and then especially if we get back through that June high, yeah, we're going to have to watch and see what's going on in equities and see how the stock market is handling that. Let's move on to talking technically. And I always like to start with the S&P 500. It's the benchmark. It's what I try to outperform. So it's a chart, obviously, I'm looking at every single day. I've mentioned that we were below the moving averages. This is what I was talking about here. You got the 20, you got the 50. 20 still above the 50. So the configurations are not exactly bearish. Are not completely bearish, but we do see the daily PPO moving back in the negative territory. So at least in the short term, it certainly appears that the bears have the momentum. And there are a couple of levels. I actually have been talking about 3,900 to 3,921. And I'll show you the numbers or why I'm using these numbers. First of all, I think it's pretty clear that back in May, excuse me, back in May when we set this low, we came down here to 3,900 on multiple occasions. And you can see held there, hammer here we held, another move below here, which we held, and then we rallied. So that left 3,900 as pretty good price support until we gapped below it right here. So then we had this gap resistance at 3,900. And then on the way back up, this reaction high, we went up to about 3,920. Never got a open or a close above 3,920, but pretty close. Here, the high 3,900. When we came back down here, we closed at 3,921. And notice we gapped up from that 3,921 close and never tested, never filled that gap until Thursday and Friday of last week. So Thursday, we put in that hammer right at gap support. So I'm going to draw another line right in here at this gap support level. And so this is the 3,900 to 3,921 level that I'm talking about. We closed 3,924. Intraday, 3,906. I think we were a little bit lower on Thursday, maybe 3,903, I think was the number. So this has been a pretty significant area over the past 3 or 4 months. And for those of you who believe we're going to double bottom or even worse yet, break down again, obviously got to take out this area of support first. A couple of weeks ago, when I talked about where I saw the market going for the next, for the rest of this year and into beginning of next year, I laid out 2 scenarios. It was right after this candle where we came back down and broke below the 20-day moving average. And I thought we'd do one of 2 things. That candle was pretty bearish, losing the 20-day moving average, maybe losing a little bit of kind of a sloppy neckline. Anyway, after coming back down and breaking down there, it looked to me like we would go down first to this 3,900 level. So this was the level that I pointed out to as scenario number one, where I thought we would go down here and then rally the rest of the year, or scenario number two, where we would break this level. And if we do, I think that absolutely opens up the possibility for 36.36 retest. I don't believe we're going to get down there, but from a technical perspective, I mean, if you're trading below both your moving averages and you take out key support, PPO's weak, clearly, you know, and there's a lot of bears out there. There's no doubt about it. We're going to talk about sentiment in just a little bit, but that could open the door, especially when you get volatility moving up and you've got a lot of fear out there. The market moves lower faster than it moves higher. That always happens. The market, you rarely see panic buying, but you oftentimes will see panic selling. So watch 3,900. I think if we lose 3,900 on a closing basis, I believe it's not certainly not a guarantee we go back to 36.36, but the odds would improve significantly that we go back and we get a double bottom at a minimum. So that is where we are at this point in time. Let's come out of here and take a look at the NDX. So this is the NASDAQ 100, which I also like to follow. And there's not really a whole lot different here. Again, we're looking at this gap support from July 26th. That was 12,086.90. We closed 12,098.44, 12 points away from it. Very similar configuration to what we see on the, or what I just looked at on the S&P 500. So again, PPO down below the zero line. You can see the price action below both the moving averages. So definitely issues in play still with the NASDAQ 100. Let me show you the last thing here with talking technically. Let me show you the ratios that I like to follow. And for those of you who are new, one of the reasons why I called a market bottom back in mid-June right here, one was sentiment, which I'll talk about in just a couple of minutes, but that low right there, prices as they kept going lower, we kept seeing three key sustainability ratios that I followed, kept putting in lows until we got to June. June, they started to turn back to the upside. So the first one is the QQQ versus the SPY. That's just simply the NASDAQ 100 versus the S&P 500. The NASDAQ 100 is much more aggressive, more growth oriented. And while the S&P has growth stocks in it, it is not nearly as growth oriented as the QQQ. So the spiders want to see how money is rotating between growth versus more value. And that's why I watch the QQQ SPY. XLY, XLP, this is probably my favorite ratio. If you use the correlation coefficient at StockCharts and you go back 20 years, you'll see why I like this as a sustainability ratio, because its correlation with the S&P 500 is very, very positive, meaning that the two tend to go hand in hand. So when they don't, it's worth noting. Here, we were going down, set the new low in May, but by the time we got to June, we never went down and set a new low in this ratio. The reason that's important is that consumer spending is 2/3 of our GDP. This is a view of the two classes of consumer spending stocks. You've got your consumer discretionary and consumer staples. Consumer discretionary being the XLY, consumer staples being the XLP. That relationship, I think, is very important because the XLY is comprised of companies, the two biggest companies in the XLY, Amazon and Tesla. They sell us things that we want for the most part. Amazon starting to sell more things that we need. You know, you can get a lot of things from Amazon that you can get from a grocery store and that sort of thing. But Amazon still sells us mostly discretionary items. Tesla clearly is a discretionary item. You don't go buy a Tesla if you're feeling bad about the economy, bad about your job, bad about your financial standing. The last thing you're going to think about is buying a Tesla. So those are the types of companies that you're going to look at in the XLY. In the XLP, you're looking at companies that sell us the things that we need. We're going to buy it no matter what. Hopefully, you're going to buy toothpaste no matter what the economy looks like. And if the economy looks great, I can only say from personal experience, I've never walked into a store and bought a lot more toothpaste because I was feeling great about the market, or skimping on toothpaste when the market is weak, when the economy's weak. So the XLP is a ETF that tracks companies that are going to be relatively flat. They're not going to be as volatile as the XLY. The XLY, these companies are going to be extremely volatile. And so looking at the ratio, I think gives us a really good look at risk on versus risk off. And so when you see the S&P 500 going down and setting clear lows, almost 10% below prior lows, 7, 8%, whatever it was, and then you come down and you look at these ratios that don't even go to a new low, what that's telling me is that, yes, the market's going lower, S&P's going lower, but money's rotating. Why is money rotating in the more aggressive XLY? That's kind of the thesis behind. And same thing back at the end of last year in 2021. Money was rotating out of the aggressive groups and into defensive groups right before the 5.5-month cyclical bear market. So these are important signals. Are they the absolute guarantees? Of course not. Nothing is. But to me, it's a very important signal, and one that we should at least respect until it breaks down. And so for me, it's going to be another new low in these ratios. The IWF IWD is just strictly large cap growth versus large cap value. And again, going down with the market through May, but in June, it had started to turn back up. So money starts rotating into growth versus value at the large cap level. Why? Well, that's a question I think everyone needs to ask themselves. And maybe it doesn't matter to some of you. That's fine. It matters to me. Now, what I'm looking at on the S&P 500, we came back down and tested this gap support. So if you look here, we're basically at the same spot we were back on July 26th. So 5-6 weeks later, here we are, same spot. When I look at the XLY, XLP, looks like we're back at about the same spot that we were. Maybe we're a tad lower. It's hard. I can't quite tell, but it's pretty darn close. When we look at the XLY, XLP, I think it's pretty clear we're higher. So even though the benchmark's gone up and come back down to the same spot, there's been more money that's rotated toward XLY versus XLP. I find that to be bullish. And the reason I mention this, I've had some questions come up and say, the S&P is going down and so are the ratios. Is that bad? Does this mean that the bear market's resuming? And so I want to explain, first of all, if the market goes down, chances are these ratios are going to go down. When the market goes down, aggressive groups tend to get hit harder. That's just normal. So the fact that they're going down is just they're going down with the S&P. I'm looking at these relative lows. I'm trying to see in the bigger picture, is money rotating into or out of discretionary versus staples? Is it moving into or out of growth versus value? So I think you have to look at this kind of over a longer period of time. And I'm okay. You get down to the IWF, IWD slightly higher from where we were July 26th. So the QQQ spider is about even, but the XLY, XLP, which is probably my favorite ratio, is significantly higher. And even at the end of last week, it was turning back up again. So I think we've got some pretty good signals still from these relative ratios, the sustainability ratios that I like to follow. All right, speaking of relative ratios and relative strength, let's move on and talk a little bit about relative strength. I'm going to start with the technology group because I was very, very bullish when technology broke out versus the S&P 500 because many times it has signaled some pretty good stuff. Once it makes this breakout, we get this crossover. Normally down here, you can see this crossover and the breakout, and you can see what's happened subsequently. Well, this one's not looking quite the same. Now, if technology on a relative basis goes back down and breaks to a new low, that would be a major check mark in the bears column. I don't think it's going to happen, but I also didn't think it would go back down and roll over below the moving averages. So this is one ratio that I'm going to continue to watch pretty closely. Discretionary stocks have actually held up pretty well, even though the market's pulled back. Discretionary relative to the S&P 500 sitting pretty close to about a 4-month high right now. And that gets back to that XLY, XLP. So for whatever reason, you know, if you think that rates are going to keep going up and it's going to trigger a big recession, I think we're already in a recession. But, you know, the government's going to decide and tell everybody when there's an actual recession. So let's just sit back and wait for them. A little sarcasm there. We've seen negative GDP 2 straight quarters. If it's not a recession, I think we can agree that it's a slowing economy. You don't contract in GDP 2 quarters in a row while you've got gangbuster economy. It just doesn't happen. So we've got some issues. We got rates still going up. If you believe that the economy is going to just fall apart later this year because of the Fed raising rates and everything else that's going on around the world, I would question why the XLY is still sitting near a four-month relative high versus the S&P 500. This should be the group that really gets hit. My belief is that the stock market looks ahead and it predicts. Look at what happened to the consumer discretionary group relative to the S&P 500 starting back in November of last year through May. I mean, we haven't seen anything like that in a long, long time in terms of discretionary stocks, their relative performance performing so poorly. I think it was priced in. That's what the stock market does. It prices things in ahead of time. So now everybody's talking about, oh, the recession is going to come and blah, blah, blah. And yet consumer discretionary stocks on a relative basis are rising. I think, again, you have to ask yourself why. Communication services, still just nothing here. I mean, the only thing that I could possibly point to on this chart that looks even somewhat appealing would be the fact that we keep going lower and the relative PPOs turned higher. So there's a positive divergence. Is that going to be enough to get this group going? I don't know. It is a beaten down group. I mean, if you're in this thing for maybe the long haul, you can probably find some really good stocks in internet, broadcasting and entertainment. Those are a couple of key areas that have been beaten up, especially internet stocks. If you believe like me that we are still in a secular long-term bull market and you're more of a long-term, don't care about what happens for the next 6 months, but you know, you're looking at a year, 2 years, 3 years, I'd be looking at some of these internet stocks that have been beaten up so badly. Maybe just put a little bit into a basket of them because who knows which one's going to lead coming out. But I do think eventually we will see some strength. But, you know, my philosophy as a trader is I like to see momentum, and there's just no momentum here with the XLC just yet. Industrials, I don't know if you've been noticing, but they continue to perform very well on a relative basis. Again, if you think the economy is going to be weakening down the road, I would have to question why the XLI relative to the S&P 500 is now at about a 15-month high. Seems kind of strange to me. Financials are improving. Financials go along for the ride. That's what I always say about financials. I don't need financials to be the leader. I don't want them to be the laggard. I don't want them to be, you know, trending down like we saw in 2020. This, you know, part of this, it wasn't so much that financials performed awful, it was that everything else performed so crazy good. That was back when technology stocks, the growth stocks, were absolutely exploding. So you got to look at this and see that off of this bottom in March in the pandemic, financials were coming back. They were performing. They just were underperforming the S&P 500. And they've continued to move higher, went through troubles during the first 5 months of the year, and now have moved back off the low. Potentially on an absolute chart, I see a left shoulder, neckline, left side of the neckline, head, right side of the neckline, and a right shoulder. Pretty symmetrical. So if financials were to rally, get back through 35, 75, 36, that would be a very, very bullish development and something to watch. On a relative basis, August has actually been a pretty good month for financial so far. Healthcare, big move up here on a relative basis, pulled back, starting to strengthen again. Consumer staples, pretty strong during the first 5 months of the year, 5-6 months, but that's typical during a bear market. This is where you would expect leadership to come from, all of the different defensive groups. So I think very, very good action for the first 5, 6, 7 months of the year, 6 months. And then we've pulled back, starting to rally again as the market pulls back. I think we're going to roll over as the market goes back up again, though. Real estate, strong earlier in the year on a relative basis. It's come back, not really looking very good there. Utilities has probably been the biggest surprise for me. I did not expect another breakout in utilities, but we've seen it. So at least for now, utility showing really nice relative strength. Energy bouncing back, still got some work to take out that early June high, but overall still uptrending, trending above the 20-week moving average there. I think that one looks pretty good. Materials, despite all the inflationary pressures, material stocks have really struggled since back in May. Huge move down in June and just been going sideways here. So I would be thinking, inflation, if it was a big problem, you'd be seeing many of these material stocks doing much better. So this would be another one of those things I would point to and say, what long-term inflation? Why are material stocks trading the way they have for the past 2 or 3 months? So I don't know what the Fed's talking about. What I see on a lot of these charts just doesn't add up. All right, let's move on. So next up, want to get into sentiment. Just want to do a quick look. I want to show you, this is the daily put call ratio, $ CPCE. And what I like to do is just, adjust the chart a little bit here. I want to put it invisible, so the daily stuff will go away. I want a 5-day simple moving average. I don't care about that. PPO, I don't care about. Volume, I don't care about. And then down at the bottom, I'm going to put price in, the S&P 500. Just do a solid line and height there. That should do it. And so this is the 5-day moving average of the equity-only put-call ratio. And down here at the bottom is the S&P 500. All I want you to do is when we peak, and especially this is the last year, we didn't have a whole lot of pessimism the last few years because of the solid market that we've had with the strength after the pandemic. But recently, and this is what I talked about back at the beginning of the year, I wanted to see sentiment reset. And by sentiment resetting, I wanted it to get back the 5-day moving average of the put call ratio to get back to 0.75 to 0.8. That to me was a reset. That's where we've marked significant bottoms in the market before. Well, in May, we got to 0.75 twice, marked both of these bottoms. June, that was one of the main reasons I called the bottom. We finally had sentiment go above 0.80 on a 5-day moving average. So everybody now is saying bear market, bear market, bear market, and yet still keeps moving higher. Look at where we are now and where the S&P is. I think we're going to bounce. I don't know when, but I think it's going to be coming very soon. All right. I tell you what, I'm going to give you for earnings spotlight and the 3 you must see. I'm going to give you 3 stocks that will be reporting this week. The first will be later today, Coupa Software, COUP. AD line week, relative strength horrible. I would not be expecting a very good report here. Next up, Zscaler. I think Zscaler reports Thursday. AD line's not bad. Relative strength, though, still not good. Another software stock. Some of these software stocks have been getting hit really hard, too, so you got to be careful. Finally, DocuSign. Are we going to turn things around? Market doesn't think so. I think we could see another rough report out of DocuSign. Anyway, that's it for me today. I appreciate everybody tuning in. Check out earningsbeats.com for our next Trading Places live show. You can go over to Earnings Beats and just hit the Trading Places live after 8:45 and join in. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.